Hi, this is Shane with The Rational Trader. It's Thursday the 28th, and my result for the day is a pretty spectacular amount in the 6E, which we're going to look at in just a minute, and then down 2 ticks in gold on a couple of trades, and then down 1 trade or 7 ticks in oil. Let's take a look at the euro, which is the one causing the big uptick in profit here. So the overnight was here. Oh, I'm sorry, that's not correct. The overnight's here, London Open. And we start off with a loss, so we get short up here. And then that's actually interesting because you're breaking through there. That almost looks like there's news. 3:03 in the morning. And then here's the 5:20 a.m., which is the what I call the Euro session open. If you look at the volume, you'll see why. It used to be when there was a pit. That's when it opened up. The volume still follows that time. So we fall down here. The POC resets, and then we start thrashing back and forth along it. It breaks lower, and then I had some members get short here and catch some of this off of this 113 code right there. It thrashed a bit and then fell for them. I didn't take that trade. I'm running a different set of models and codes as I'm evaluating this outside the value area approach. So I end up getting long right here, which is simply an amazing entry. Okay, so it's off of this 237 signal, and we wait for the next up bar and then get in. And then the system, we auto add right there. Okay, and what happens when we add is that we automatically reset the target to break even plus the amount we're using, which for the yen, I'm sorry, for the euro is 50 ticks. So the entry here at 37.65, it has a target up here somewhere. But as soon as we do the add, the break-even value is down here, and that resets the target to that level plus 50 ticks. And so the idea behind that is that if you got a signal to add, then there's an expectation that, or a belief that the market's going to continue in that direction. So you don't want to just stop at the previous target level that you had defined. So we get this nice strong run here after a retest of the low, and then on this pullback we add, and then the market it takes a little bit before it decides to pop again. This is a fairly late add, I think, but it worked out really well for me here. Because I'm using a bigger trail in the euro. So the analysis showed that the 15-tick trail is too tight, and so we're using a 20-tick trail, which happened to be just below there. All right, and so the market pulled back, almost got me, and then went up, and then tried again and failed. And now you're at the POC, so you have no idea what's going to happen. And then we get one more pop, and it happens to be that's the exit, the break even plus 50 exit. And look at it's just amazing. We call this a golden exit. It's actually a golden entry too. Not quite golden, but and you'd like to take credit for that. Oh, it might, the machine learning system is awesome. It's not. We just got lucky because we're using 50 ticks, and it went just enough to hit that target and we're out. Worst case would have been 15 ticks lower than that. And then we get take a short here, okay? And again, with that 20 tick trail, make 5 ticks. So it goes 25 ticks and then pulls back and we get taken out there. And then another long, so a pretty active market here. I'm sorry, another trade short. In this case, the market's not falling, and we take a 7 tick loss. So a total of 92. So plus 100. Let's see what it should be. Plus 70 and plus 32. So it looks like plus 102. And then minus 2 here, and there was actually there was a minus 8 earlier, so that's where the 92 comes from. That's right. Okay, so but it's interesting because we've been talking about in the room. We've been talking about the results we saw in the December timeframe were really positive. In January, we ran an experiment, and it wasn't a profitable experiment, though it gave us a lot of data. So you sort of have to take that one out. But then in February here, we've just kind of been marking time and haven't really been making lots of progress. And really what February has been about is expanding what we did in December, but to more markets. And it's, the question is, well, why aren't we seeing more of these, catching these kinds of moves, sort of like we expect, or kind of what the analysis shows. And it's really not clear yet whether it's, the lazy answer is that the markets are random and it's one of those times, but I don't think that that's necessarily the case. I don't want to take the lazy way out. So I'm doing actually a fair amount of analysis to understand if the mechanism that we use to identify which behaviors to look for in a market are aging out because of the way that we do it. So, and what we're doing is, we're looking for common behaviors, but across a long time period. And so it's certainly possible that that's a perfect way to do it. But the fact is that there are times when those behaviors aren't showing up, and as you redo your analysis, you sort of catch up. One of the things we'd done in January was try to take the same approach but on less data, and it was a disaster in terms of helping to find good trades. And so what I'm doing now is another experiment, which is sort of basically combining these two ideas of looking at it long term and then looking at it in the more immediate term, and to see, is there a way to, sort of, is that the problem? Is the problem that we're aging out, or is it that the basic analytical process is just flawed and we got lucky in December? That's certainly possible as well. I don't think so. There's a logic behind what we're doing here. It's a testable hypothesis. So the problem is that the actual testing in live conditions takes, it happens in real time. So there are definitely times when you go, you go through droughts, and that's the nature of trading. It's the nature of the market because it's responding to lots of external factors that we don't have any control over and you can't predict. And so anyway, I'm not done here. There's some more work. There's another slide there, and I'm not ready to talk to yet. But the approach that we've been taking is basically waiting for something like this. So take a defensive posture, stay in the game, and then when you get the big trade, cash in, and then keep playing defense. All right. So this is the one thing great about the machine here, is that it didn't get excited. It didn't chase. It didn't stop trading. It didn't take lots of more trades because it had made money. It had made money that day, and so now it's playing with house money. There's none of that going on. It's just doing what it does. It got short here because that's the that code shows up, and it's time to get short. And who knows what could have happened there. But the point is that there's no emotion involved. It's just doing what it's told to do. It's just matching patterns of price action and order flow. Okay, and so ultimately that's the real benefit that I'm seeing from what I'm doing here, is that there's just no human emotion involved. And the question in my mind is, can we get I gotta be careful how the phrasing here. One of the things I'm doing by switching out to more markets at once is to smooth out the amplitude, smooth out the bumps. Okay, so that one market can be up, can make up for when another market is down. But if overall over the long term they all analyze as being profitable opportunities, then you can reduce the amplitude, reduce the amount of the loss, because we control that risk while still taking advantage of the bigger moves. So that approach still strikes me as positive. The question is, is there a way to get to do this analysis and get a little more dialed into the current market condition, or do I need something else? I'm not done yet. I still think there's some work there. Is kind of the point. Today, though, this is the kind of day that will make the week. Hang on here. Let me find the sheet. So this is the results for the week. All symbols non-sim. And on Monday, that was a nice day. If I recall correctly, it was in the yen. Yesterday was basically scratch, down 875, and then down 108 or 109 on Tuesday. Today, plus 45, and so for the week, you're at 581. And I think what we're talking about is be defensive and then be in the market to take advantage of these bigger days. And what we don't have enough time yet to know within live conditions if that's viable longer term, or should you just focus on a single market and dial that market in and just deal with the the amplitudes of the losses. You get more max loss days the smaller the number of markets that you're trading. Okay, so we'll see. There's some interesting stuff going on in terms of analysis, but certainly you could look at what we've seen this week and go, okay, well this is kind of what we're after. Let's see, what does it look like for all of February? Hold on. Yeah, so here's all of February now. This is the first full week. 2-4 is the first full week of February. And kind of what you see here is we had this stretch where you didn't have any of these nicer days. I mean, maybe you started off quasi nice, but gave it all back the next day, and then that was kind of the worst. But minus 210 one day, minus 188 was the other sort of big loss day. Neither of those reach my max loss daily limit. But this was certainly not a fun stretch, right? So you had, what is that, 3 weeks? 3 weeks of February where there was you're just surviving. And so the question is, is there a way? Is it possible to get more of these nicer days sprinkled throughout here, or not? All right, and so we'll see. We're zeroing in here, I think, on how to approach it. So we'll talk more about that probably over the next week as I finish sort of what I'm doing in terms of looking at different vectors of the machine learning output, the analysis of the machine learning output. Okay. All right. So we got a little abstract there at the end, but that's it for today. We'll see what tomorrow brings, and then March is upon us already.